Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Okay, welcome to The Wealth Flow. My guest today is Rob Haynie. He has been a major influence on the evolution of the life settlement industry during his 32-year career of proactive involvement. Not only has he been directly involved in negotiating and settling several thousand contracts, he also presently serves on the board of the Director of Life Insurance Settlement Association and is a charter member of the association's PPC committee, which is charged with the regulatory and legislative activities of the industry. Not only that, in October of 24, he was a recent recipient of the prestigious Alan H. Burgess Leadership Award. So I am looking forward to diving into this, Rob. Thank you so much for being a guest on The Wealth Flow.
Well, thank you for having me. I really appreciate you taking the time to listen to my story.
Yeah, absolutely. And I love to hear everybody's background. You know, what eventually led you to the life insurance settlement industry, kind of where you grew up. I know that's going way back, but it's always interesting to hear everybody's story before we dive into what they're currently doing.
So I can make that really short for you. I grew up in southern New Jersey, a town called Wildwood Crest, beach town. So lots of fun things to do in the summer, especially get jobs at age 11 on up. And then I graduated high school and had surgery to remove a rod out of my right leg my fall semester, would have been my freshman year in college. And it is then that I learned that there's not a heck of a lot to do in Wildwood Crest, New Jersey in the winter and the fall. So I decided that I would make my move once I graduated from Florida State to Florida. And that's where I moved to Orlando, went to work for my college roommate's brother in commercial real estate. And when I was at the gym one day, I was approached by a friend of mine that I knew in the gym, and he came up to me and told me that he was at a new job and he was helping people sell life insurance policies that were dying of HIV and AIDS. And my instant gut reaction was, that's the most coolest thing I've ever heard in my life. And, he said, well, you sure you don't want a job? It's, we can make some money. It's really, really cool job. And I said, well, let me think about that. So I got in the car and literally drove about a half a block and got to the light. And I thought to myself, I said, wait a minute. We're helping people get money out of a life insurance policy that otherwise we're going to lapse or surrender for cash value. In this case, it's mostly lapse. And they can use it for things that they need. In this case, it was medicine that wasn't readily available or FDA approved to combat HIV and AIDS.
Yeah.
And I said, I'm in. And I told my then girlfriend, now wife, and she thought I was insane. My mother didn't talk to me for 3 months. And 32 years later, I'm on your show. So that's my story.
Wow. Yeah. So going from commercial real estate into selling policies. And so prior to that, you didn't have any necessarily industry experience in actually selling life insurance. It was just converting those existing policies into cash value for...
Well, yeah. So when you think about a life insurance policy, most people think of it as an expense. So when you buy a life insurance policy, you have a bunch of reasons why you want it, you need it. and you look at the premium that comes due, whether it's monthly, quarterly, annually, and you think, okay, that's an expense. Your accountant probably thinks of it as an expense. And then 90% of all the life insurance policies that are ever issued in the United States of America never go to claim. So they're either lapsed or surrendered. So most people never really realize it's an asset they own like they own their home.
Yeah.
So we try and teach people, educate people, financial planning communities and others that when you have a life insurance policy that you no longer want, that you no longer need, or in many cases you can no longer afford, wouldn't it be nice to find out if someone would offer you more money than just what the carrier would offer you? So the carriers have enjoyed forever, the word I use is monopsony, meaning they're the buyer, they're both the seller and the buyer, and you can only sell back to them, and here's the cost, and it's non-negotiable. That's a monopsony. We create a marketplace. So we say to somebody, well, if the carrier is going to give you $100,000, the investors on average are going to give you $650,000. And then we say, which is better for you, $100,000 or $650,000? And we're batting 1,000 in that question and answer session. And people then take the money and they use it for what they need at the time. If the procuring cause of the sale is an insurance agent, for example, he or she get to sell them a policy, in this case, an annuity, with the proceeds from the sale of the life insurance policy. And now they go from having to pay money every month or quarter or annual basis to receiving money in the form of an annuity payment. And that creates a second life for a life insurance policy. Neat to say that the life insurance policy stays in force, so any trailer commissions still come to the agent, and they make a commission on the new sale. But the client is better served because the client now has something they need, which is income. They don't need the insurance because they paid their house off, their kids are going off to college and are on their own now. And the policies become more expensive. And that's what happens to most people, is they don't know there's a safety valve or a life raft, so to speak, for them when it comes to their life insurance policy. So it's our job to tell them that. Now, I'll say this will sound tongue-in-cheek, but it's true. Our industry sells about $5 billion of death benefit a year. But the life insurance market, we know, for people over the age of 65, lapses or surrenders $112 billion every year. And we've been doing this, as you know, for over 30 years, 32 for myself. And so we're the worst salespeople in the history of the world because we've only managed to get to about 4% of the population that can benefit from this, and the other 96 have no idea. So that is why, Keith, I go on shows like yours, because I get to talk to audiences that I would never otherwise talk to. And they can explain to them that is their policy. And what I mean by that is if you own a life insurance policy and you don't really need the money, but you don't really need it for the reason you originally bought it, you can gift that to a animal shelter. You can gift it to your neighbor, your neighbor's dog. It's yours. People don't know they control their life insurance policy. So it's probably in many cases the second largest asset they own outside of their home. And in some cases, in the case of renting, it's the largest. So they don't know that they control it. And that's what we try and teach people.
Yeah, it's very interesting. And so, as you mentioned, a lot of times people will let it lapse because essentially, a whole life policy, you're essentially paying on it. I get there's variations of it, but for the most of the products that are out there, if they're whole life, they're paying their whole life premiums. Correct? Yeah.
Well, think about lapsing. Because when you think about lapsing, it's unfair to say that everybody gets to be old and then they lapse their policies. That's not the case at all. When you go to work at a college, for example, at a company, ABC Corporation, you work there for 3 years, you're given a benefits package. And inside that benefits package is a life insurance policy that you're paying on every pay period. You don't know you don't really look at it, but it's there. And you can pay whatever it's $1 a month or 50 cents a month, whatever it is. That policy is yours. So when you go to work for DEF Corporation 3 years later, you have every right to take the policy with you. You would port it and become your individual life insurance policy. The premiums will go up because we're no longer kicking in as the employer. So it's more expensive. So young people typically don't let those. So that's what lapses the majority of the time.
Oh, really? Okay.
They all lapse because why would you take them? When you get to be older, back when we were in the HIV and AIDS days in the late 90s, many of the customers we had were part of groups. So when they were leaving work because they were sick. Yeah. So we were advising them to take it with them, regardless of how much it cost, because they weren't going to be paying the premiums anymore. The investor was. So when you think about airline attendants, etc. That was key information to make sure people knew they could take it with them. Certainly government employees could do the same. So the same applies today, but generally speaking, the life and settlement market is more from really being a terminal illness only focus to terminal illness to a degree on up to you can be a healthy senior. You don't have to have any health issues. You just are older. So your life expectancy is more predictable. And that's what the investor's looking at. How long will I be paying the premiums until I get the return? And they can't just pick one. They can't just say, okay, here's 100 deals. I'm going to pick that one. Because what will happen is that person will live to be 135 years old. That's just the way it'll work. You want to pick about 40 of them, and then you'll have the mix of some will pass away, unfortunately, right away for whatever reasons unknown, and others will surpass the life expectancy projection. It's just natural the way it works.
Yeah. Okay. So they're buying these things similar to notes being sold on the on the market. They're bundled up together. There's some predictability from an investor standpoint of saying.
Think about an investor, because this is a great topic. This will be something you'll be interested in. The reason that life settlements are popular and why pension funds and other funds like them and would like to have more of them is they're uncorrelated. So when the market has a hiccup and goes down dramatically over a period of time or just in one day, what happens to the insurance policy that you own? Does the insurance life expectancy get shorter or longer? No. Did premiums go up? Did the death benefit change? So they love it. So it's an alternative asset that they can mark on their books as this one. We really don't have to babysit. Now we have to babysit all the other things because we just don't know. Someone makes a statement on Friday afternoon, and then who knows what happens in Asia the following Monday. So those are things that we don't pitch that. That's what the people that we sell to, that's what they work with. There's a company right now that's Abacus, which is gone public. And they're pitching that same to their investors, that this is to buy a lot of policies and really let that bell curve take shape, because the life expectancy says, well, what's the person's life expectancy? I said, well, here's the line, and anywhere on that is the life expectancy. They could die right there, they could die right here, but most of them will die here, and that's how the market has worked. Now it's not exact, but I don't know what is. But at the end of the day, we certainly don't know people are going to live forever. That hasn't happened yet. So when that happens, then we'll have a little bit of trouble here in the life settlement market. But other than that, I think we're good.
Yeah, for sure. Yeah, I've definitely heard Abacus. They have commercials and everything on TV.
Absolutely.
So I've heard of that one. And it makes total sense. I mean, a lot of times when you're doing this, you're getting a lot of these policies set up in your 20s, in your 30s, in your 40s, and your situation oftentimes changes, right? So you're in a totally different financial position later in life, and you may not need it for the same thing. It's a responsible thing to do when you're younger and you're building your wealth, but ultimately, at some point, if there's no question as to whether or not you're going to have something to pass on to the kids or to pay off those mortgages or put the kids through college, whatever it may be, you can repurpose it. Is what it sounds like.
Exactly.
So tell me a little bit about that. How does that work? I mean, are we talking? You gave an example of maybe working for a job and it was supplemented. Now, if you didn't do anything with that, so let's say you were with a company for X number of years and you left, and that policy lapsed. I know generally, or most of the time on say a whole life type policy. I don't know how it works with a term or any of those, but if you've paid in X amount and you don't stop making payments, it goes into a reduced paid up status, right? Does it do that with most of the benefits packages, or if you didn't convert it or hold on to it or do something with it, it's basically just money lost?
Well, I would say overall it's money lost, because most of the policies are giving you a term. They're not going to give you anything that builds cash value, because they're not taking their own money. Because really, putting cash value is just overpaying the premium. Like when a buyer buys a life insurance policy and the premiums were X number of dollars per year, and they become the new owner, They will optimize the premium. They'll go into shadow accounts and they'll literally pay about 60% of what it's worth, and the death benefit will stay the same. That's the thing. They don't teach you that because, everything's a term policy. There's always a chassis on it when it becomes a UL or a whole life, or any of the GULs, IULs, etc. So you can either, A.L. Williams, I think, used to say, buy term, invest the rest, right? As opposed to buy whole life and invest in the whole life. There's always this schedule. You can tax-free loans, et cetera. There's all these complicated different things. They're all moving parts. One of my favorite examples was an agent I met out of Louisiana. And this is like turn of the century stuff. So he's at a function, and he came in with this giant stamp, the one you press on the back of checks, et cetera. And it said guaranteed. And then in small print, to never be the amount of money you'll pay on this policy for the life of the policy, but on and on and on and on, and then signed his name all in the same stamp because he says it never happens.
Yeah.
They're always different. And that's the thing about life insurance is we tell clients, especially when looking for life settlements, but more importantly, understanding your book, is to constantly review the policy. The carriers will make subtle changes. They'll drive up the cost. They'll cry poor mouth. They're like, oh, we're not making enough money. And I always say, well, I remember back in 2009, they handed out TARP money to all the investment banks, but I noticed you didn't get any. How come you didn't get any? And the reason is they didn't need any. They have a business model of 90% of every policy they write, they keep. The other 10 they pay out, but they invest.
All right, Rob. No, that's very interesting. So, with somebody's policy, like you said, oftentimes they just don't know that they have that as an option. They think oftentimes they have to wait for that death benefit. One thing, what are some of the options if somebody does decide that, hey, I no longer need this policy? They've got some options. They can cash their policy through the insurance company for quote unquote the cash value, but I understand that's going to be at an extreme discount compared to even if they let it go reduced pay up. Can you explain a little bit of that to the audience and kind of how that works?
So that's a great question. So typically, and I want to say, if you have a cash surrender value option and you're younger, that's going to be your life settlement option. We're not going to beat that because you're going to live too long to be a life settler. So most people will surrender their policies for the cash surrender value when they're younger, meaning in their 60s or 50s, should they have any cash value, because as you know, you can use that to pay premiums. With us, it's an option of when people typically get to be age of 65, 70 years or older, and they no longer want the policy because it becomes extremely expensive. They'd rather use the money for something else. Then they look to a life settlement as an option. So again, it's all predicated on life expectancy. So the longer you have to live, the less money you'll receive in terms of your death benefit. But what's becoming in vogue to us more recently is people want to age in place as opposed to take all the money, the equity out of their home, sell it, take that, and then give it to an assisted living facility who basically doesn't give them anything. They get no deed, no title. They just rent there. And they want to do that to their home. So they keep the equity in their home. They use the proceeds from the settlement to help, whether it's put ramps up and down and in and out of the house, to enlarge a hallway, a doors as opposed to the bathrooms, walk-in tubs, etc. That's become popular. So that's what we typically can say. But the options are, you obviously could surrender. If you have an accelerated death benefit option inside your life insurance policy, you should always try and look for that should you have it. That will give you a lot of money, but to qualify for that, you're going to almost be terminal to do that. And then as far as the settlement goes, we can sell your entire policy and you can get the cash for that. We can sell a portion of your policy. So if you have $1 million policy, you can sell $500,000 of that, keep $500,000 for yourself. Or you can do one of the newest things that people do is they do a retained death benefit. And you say, Keith's going like, what the heck is that? Well, that is when we can take your policy, $1 million policy, and instead of giving you cash, we can assign you a percentage of the death benefit right then and there. And then through the remainder of the policy life, you'll still remain on there as a percentage of that. It doesn't decrease. And when you die, your named beneficiary will get that percentage of the death benefit. So that's like having free life insurance, but don't have to pay for it. You follow me? So
Yeah.
that's an option too, becoming very, very popular. That's a newer wrinkle in our business, but those are things that people can look for. And that's what we try and educate all the people we work with, our thousands of agents across the country, to explain to them that there's always an option. Let's take a look at all the options, and then we make a good informed decision about what to do, because we now have all the options in front of us as opposed to just a hypothetical.
Yeah, yeah, makes sense. So, at what age does this tend to make sense? If you've had a policy for X number of years, I don't know. In typical, what would your average customer
I would
that's
say
like, okay, this
70
makes sense
years,
at this point?
70 years is about the best age
Okay,
to start to look. 60 years or older if you have a term policy. And the reason I say that is most people have up until age 70 to convert a policy. So if they're 68 years old and they have 2 years left in their conversion, and then you get a conversion illustration, that's when all the hair on your head either falls out or turns completely white when you see the number. They will typically lapse that policy outside of the settlement. So we get to go to the buyer and say, okay, Mr. Smith would like to sell his policy. This is the conversion premium. Here's how much it'll cost to keep it going. And then Mr. Smith gets some cash for that. The reason it's exciting for a buyer is what happens when you convert the policy?
it
It's a
has
new
a kid.
policy. It pays a commission, and the buyer gets the commission. And they
Right.
utilize that to manufacture the offer. That also pays a commission to myself and the originating agent. The client gets money out of that, plus a little bit from the buyer, and they move on and say, well, who the hell is going to sell a $1 million policy for $10,000? And I go, the person who's going to let it lapse for zero, because
Yeah,
the person when they're selling it in their 60s might have 30 years to live. It's a long
yeah.
time. So that's what the buyer said. That's another newer wrinkle. Longer life expectancies. You know who likes longer life expectancies? I mentioned earlier, pension funds, because their liquidity needs are not right around the corner. They
Right,
don't
right.
need the money tomorrow. They want to go as long as possible because it's sitting in that asset class called, alternative assets, and they like that sitting over there, as opposed to, having a heart attack watching the market go up and down because somebody said something stupid on Squawk Box.
Yeah. So on a conversion, if you're going from like a term policy to a whole life, and you said they typically have till 68 to do that, or 70, or
No,
what?
till age 70, majority of them. Always a
Okay.
policy, a term policy. Sometimes with a 20-year term, it may cut off shorter, depending upon when you bought it. But they're either mostly 20 to 10-year term policies that we see.
Okay.
And people have no idea you can convert the policy and sell it. They don't know that. And why would
Yeah.
they? They don't even know you can sell your policy, let alone convert the policy and sell it. So that's, again, a job for us, and why we love coming on shows like yours.
Yeah, for sure. No, I think an important point that like you said, just don't think people realize they can do. And so, what is typically, and it may not normally be an economical thing for, say, the person that holds the policy or the person that originally purchased it on a term, because are they having to pay the difference between like what the whole life would have been and the premium for the term, and that's why it seems like a huge number. But ultimately, if it's a, $500,000 or $1 million policy, that difference may be fractional compared to what the actual value would be.
Yeah, you're right. That's right.
Okay.
Again, it's all you have to see it. Most people don't even ask for that illustration. Don't even
Yeah.
ask for it because they don't know you can do it. The agents, and most of the time, unfortunately, for term policy owners, statistically speaking, more than likely, the person who sold you the term is gone. It's not your agent anymore.
Right.
So it's
Right.
nobody, an orphan policy holder. They're not in communication to anybody. They bought the policy specifically to cover that time period. And when that time period ended, they weren't going to keep it anyway. But if you say to somebody, okay, you're not keeping it anyway, how would you like $25,000? And the answer is yes. They're more
Yeah.
than likely to sell their policy. So that's why we constantly educate people about the availability of term. We actually trademarked the term life set, almost like a football cadence, because we want people to know you can term life, you can settle. And they're just very simple, just to keep that in mind, that if you got a term, It's not trash. You can go look and see if it's worth something. You know what? We may go through the exercise and find out it's not worth anything. That's okay too. But at least
Yeah.
we tried. We talk a lot about fiduciary duty in this business. And people will fight me that you're not a fiduciary. And I say, well, it doesn't matter if I'm fiduciary or not. The bottom line is a fiduciary has responsibility to act in the best interest of their clients.
Yeah.
When I'm a life settlement, by statute in the state of Texas, I'm a fiduciary. So thereby, I'm a fiduciary everywhere as far as I'm concerned. I have to do what's in the best interest of my clients. We disclose our commissions. Our commissions are disclosed to the client. They know exactly how much we're making.
Yeah.
And that's not happening when you buy life insurance. If you work for New York Life, you do not represent the client ever under any circumstances. You're a captive agent. You do not have fiduciary duty. So we can bypass them. They don't ever want to participate in it because they're not allowed. They're told by New York Life, you're not allowed to do this. And I think that's basically borderline criminal. But at the same time, they don't have to take the commission. I tell them, you don't have to do anything. We can just take care of your client, give them the money. They can come back to you and you can sell them another product, but you don't have to take the life settlement commission. And they go, what do you
Yeah.
mean you don't have to take the life settlement commission? I go, you don't have to take it. You're obviously not allowed to. So I don't want to get you in trouble. We'll keep it. We'll give some to the client and then we'll ride off into the sunset and you can sell another product to them. And we emphasize the fact that you should be looking for this opportunity. Here's why I tell you that. You mentioned Abacus and Coventry is the other name that comes to mind.
Right.
They run
Yep.
commercials, right? So if they run commercials and you're not telling them about a life settlement and they see the commercial, what do you think they're going to do? Call you? No,
Right.
they're going to call Coventry or Abacus directly. And Abacus and Coventry have earned that right to have that direct conversation with you. They may give them an offer on the spot or take 2 or 3 weeks to do underwriting, give them another offer, and the client's policy that he sold them is gone. That trailer income he's still going to get, but that new money that the client got, he's not giving it to the agent. So we
Yeah.
tell them,
No, for sure.
you have invested interest in being responsible when it comes to selling your policy. We're regulated by the same entity that regulates them. We're regulated in 45 states regulate this activity. So it's about 93% of the U.S. population. The other 5 don't regulate us, with South Carolina being the biggest of those 5. But we treat that state like any other. We operate under the NAIC guidelines as to what they can get. There's rescission periods that our clients are afforded. So if they get the money and they don't sit well at night and go, oh, I don't really like this, I want to give it back, you can within 15 days. So things like that, we put in there. We knew what was coming. We could see. So we said we can either regulate ourselves or someone else can regulate us out of business. So we decided to regulate ourselves. And it's taken about 20 years to do that.
Yeah. I'm also thinking, just because obviously I'm just reflecting on certain policies I have and stuff, but I know even when we bought a business, we had one for the term of the SBA loan, right? And so it was a term policy, but it's for that specific term of while that loan was being paid off. And I have, to their credit, I have received a few things that have talked about converting it. So it was, they at least are disclosing that in Texas to me. But I didn't even think about the potential of, what that could mean. Right?
Well, think about it. I don't need to know the number amount, but I guarantee you it has a lot of zeros in it. The death benefit you bought for that particular purpose, which is why they have a trigger for those conversion, because they want to see that policy converted and stay in force. And then later on, they'll let it lapse, of course. But business owners, key man policies, you have no idea how many people let those lapse.
Yeah, I imagine.
They just sell a business. They're like, you want that policy? And they're like, well, it's on so-and-so. He's one of the founders of the company we bought. Now they can actually keep the policy as a business owner of that policy on that person for themselves. They could do that. Some do because they're smart enough to realize, wait a minute, I can continue to pay premiums, and when so-and-so dies, the business gets it. But most people don't. And we try and teach them that these are part of the sales process. I have a guy that works with us, Brian Summey, who's on our website, and he works for a company called Vestacor. That's all they operate in. They teach people all the time that when you're selling your business, your life insurance policy comes along with that sale, and you should be able to negotiate additional funds based upon either the sale of that policy then and there or at a later date. You can put that into the contract, and we've been doing that. Now, that's one of the ways to raise awareness is when they actually physically see the money leaving their wallet. They're very interested in that.
Oh, for sure. For sure.
Yeah.
No, it makes total sense. Yeah, it's just another one of those examples of why people wouldn't necessarily know. But that's great that you're out spreading the word.
We're trying. We're trying. We're not everywhere all the time, but we're trying.
Yeah. What are some other examples of how this can be done, and kind of instances where maybe somebody wouldn't have thought of it, but it makes sense. I'm glad I had you on, just because, or have you on today, because I've always wondered when I've seen the abacus or the other commercial, like they always say even a term policy, and I'm thinking, how on a term policy? But you've answered that question for us.
That's right.
So
So, I mean, anything, we've had the weirdest situations in the world where people will come to us with deals, opportunities that don't make a lot of sense. At the time, we'll go through the process. We'll find out, "Oh, we got an offer." We'll be like completely blown away. We don't know why, because remember, individual companies are buying this based upon their individual decision making. It's not based upon what I tell them, it's what they think. Well, if others that we think, "Oh, this is going to happen, Keith, your policy is going to sell. We're going to get 10 offers." We get none. Okay. Sometimes we educate people to the point that we get them an offer that exceeds our expectations and certainly their expectations. And the money,
Hmm.
or the policy literally becomes very real to them, and they keep it.
Yeah,
They were letting it go. But now they saw there's value in it. It's almost like a nest egg you keep under your pillow, right? It's there if you need it. In the meantime, if you pass away, you don't need the money now. If you pass away, you know the death benefit's going to go to your family. So they feel like it's like it now moved from an expense to an investment. And
yeah,
that's what this is all about. We've had people that we've done that with that have come back to us 3 years later, 2 years, 4 years, 8 years, whatever, and said, "Okay, now I want to sell." And that's
yeah,
fine. And guess what? They get more money. They get rewarded for that. But they also have spent money. But I always tell them, you can't look at that as spent money, taking away what you get in terms of the cost, because you had coverage. People forget that life insurance, we learned in COVID, is a luxury. Okay. That is
yeah.
like, you put the list of things that you want to make sure you pay for, that's way down at the bottom.
Hmm.
You're not going to say, "You know what, I'm not going to eat because I want to pay this premium to John Hancock." No, but that's there. That's always a thought. So we're teaching people that, it is an asset you own, like anything else, like any other investment you've made, and you need to treat it as such. So that's why we keep preaching the fiduciary role and give them we appeal a little bit to the greed. I mean, we're all motivated by money, or we wouldn't be in this business. So we tell them that there's opportunity to make money. And then, of course, the referrals that come from it. If a client sells a policy that they didn't know they could sell and they get a whole bunch of money, they're going to tell their friends. It's the point.
Yeah, for
Going to
sure.
happen. And so we see that certainly in the terminal illness aspect. We saw that in HIV and AIDS for certain. You're starting to see it more and more, and that points to those commercials you see. That's a direct to consumer ad, and that consumers to call them directly. They're not saying call your agent and then call me. And that marketplace is opening up to a whole wide world of opportunity, because these clients are not being addressed in any way, shape, or form. No one's talking to them. They don't have agents that are monitoring their cases. And it's an opportunity for them to sell something they otherwise didn't think had any value. So that's why we like it. We love those
Yeah.
commercials. We love those commercials. And to my friends in Abacus and Coventry, who I do a lot of business with, we definitely get the calls that go, "Hey, we just saw your commercial on TV." And we don't correct them. We just move on with the presentation. But here's the funny thing. The funny thing about that is literally every policy that comes into my office, I'm going to send to Coventry and Abacus.
Oh,
Absolutely.
really? Yeah.
100%, because they're the biggest buyers there are, but they're going to be competing to buy my policy as opposed to maybe not so much with the direct to consumer, and that's fine. They don't care. They understand that. Everyone needs to buy policies in this business. It's not like they have luxury of going, "No, we're good right now with holding what we have." Constantly want to have more and more and more, because the bigger that pool becomes, the more likely that smoothness of that bell curve and the predictability kind of rises.
Okay. And so tell me a little bit from a consumer standpoint. If somebody out there, one of the listeners, is hearing this and saying, "Okay, I do want to, have Rob and his team check this out and see if there's an opportunity here." What's the process like? How long does it take to analyze it, and then to determine whether or not you can, find a buyer for it?
Great question. So let me just I tell people all the time, I like the recovery room nurse. The doctor tells you, oh, talk Keith, it's not going to hurt at all. And then you get in the recovery room and the nurse comes in and says, here's your pain medication, here's your ice pack, everything. So I'm telling
Right.
you, 90 days. You want to think 90 days. We've got to
Okay.
do a lot of stuff between then and then 90 days. We've got to collect information from insurance companies and medical doctors. We've got to order life expectancies. We've got to send it to the entities to bid. There's a negotiation process that takes place. They're going to do their own internal underwriting, and then contracts, should we have a successful sale, are going to be generated. They're going to be sent to their attorney. Money's going to be placed into escrow, and that escrow agent is going to act as the quarterback between the two. So as the ownership change takes place, they record that, and the money that's been put aside goes to the client. Client then has a rescission period, 15 days, we'll call it, that they can decide to not keep the money and give it back. In my case, in 32 years, we've had that happen 3 times, and unfortunately, all 3 of the people died within that 15-day period. That's why which makes sense.
Yeah.
That happens. So we do a lot of transactions. So when I tell 90 days, and the reason I say 90 is it doesn't usually take 90, but I never have anybody upset that I tell them 90 and it takes 60, but I've had people upset if I say 60 and it takes 75. So we tell people, let's not wait till the end. Let's get going early. There's no obligation to take the offer. You don't have to take it. You can sit on it. You can think about it all you want. It's your time. It's your policy. You can do whatever you want. But we want you to be prepared just in case. Because if you've ever called an insurance company lately and asked them, could they help you out with anything? Unless you're going to give them money, nothing's going to happen quickly. If you need to make a premium payment and you're stuck in a coal mine in South Africa, 2 miles under the earth, they'll fly a drone down the shaft to swipe your credit card and come back up. But they're not going to give you any information on your policy in any time that's quick.
Yeah, makes sense. So from that's good to know. 90 days, and I didn't realize how involved. Every time I heard the commercials and various things, I would always think, well, I wonder how they're doing this. Are they just changing the beneficiary, and then what is that working? I mean, it's not. It sounds like it's not done that way. It's truly. There's a lot of research and stuff that's involved with it. So, and then. So on the open market, the abacuses and the various people are looking at individual policies and then bundling them up, or how are they purchasing it on that end?
How are they? Say it again. I missed that. You're saying
Yeah, it sounds like they're evaluating each individual one, and I'm just wondering from you or from your company, are they buying like a bunch at a time, or are they literally just buying one at a time? It's each one kind of stands on its own.
Okay, then I did understand. So in the secondary market, which I call the ownership of the policy from the actual insured, selling it to a third party like us, that's going to be one individually done, individual underwriting. Once it's owned and it's put into a portfolio or pool of policies, depending upon whose policies they are and how it's underwritten, they can sell those in bulk. Because they'll buy based on life expectancies. They'll calculate what they think it's worth. The buyer will think what they think it's worth, and they'll come to some type of agreement. So that's called the tertiary market. So that marketplace, you'll see hundreds, 10, 15, in some cases, upwards of 2,000 policies sold in one block.
Okay.
But that's done outside of the secondary market. That's after it's already owned by the different individual investors.
Okay. In that tertiary market, if you're bundling them up like that, are they buying them then at that point at 95 cents on the dollar, 90 cents on the dollar, or how is that? Are they just saying it's
all
just trading
of LA? Depends on what they have. So somebody may come to them and say, I'd like to buy your policies that have a life expectancy of 60 months or longer. So those are going to be less expensive.
Okay.
So that's good. They want longer term holds, because when you start to buy a shorter life expectancy, you really have to, almost like golf, you got to get it close to the pin. You can't be in the back bunker. When you make a mistake early, on a large group policy with longer life expectancy, you can make a lot of mistakes, but you can also have a lot of success because people could die way sooner than they're supposed to.
Yeah.
When you have someone that's so short life expectancy, they don't die when they're supposed to, then they live past you, then you missed. You can compress your, so 95%, no, that's not going to be, I don't think, I mean, people would love to sell it for 95, and I'm sure there are
Right.
policies that are worth it, but you're gonna have to know something like that generally most people don't know. Like you know that he's going on a particular boat ride and the boat's going to sink and whatever, but that's not neither here nor there. So this marketplace is based upon when you get to be, there are buyers that literally like to buy short LEs. They love it.
Hmm.
But there's also people like to bet $10,000 on blackjack. So I don't really know who those people are. That's not me.
Right. Right. Makes sense. Makes sense. But for a general consumer, on, let's say, a whole life policy, using kind of $1 million, policy amount, or death benefit rather, what is there a rule of thumb that they can consider, or is it basically a case by case basis? You really got to look at it and say, how much, when did they get the policy? How much do they have in it? And analyze it that way, where you can tell them like, hey, look, you can expect to get about half, or you can expect to get about, 20%, or.
Yeah, I'm not good at that because it's like you just don't know. I don't ever make predictions. I don't really give ranges either because I tell people since you're going to get anywhere from 10 to 55%, right? You say I made that up. That's what I told somebody. You know what they hear? 55.
Right. Exactly. Exactly.
And they're like, you give them 54, like, oh, you said 55. But the answer is you don't know. Every deal is a
Okay.
snowflake. Literally, they're always something a little bit different in every deal. You can have two guys the same age, the same health rating, buy the same policy from the same company at the same time. And 40 years later, look at those two policies and they look nothing alike.
Yeah.
Why? Because he
Okay.
borrowed against it, or maybe he was late in the premium payment, or he started to pay quarterly and the other guy paid annually. All those different things will take over. Um, it's just it's something that we just tell people that we're going to go get you the most money we can. When we come back to the offer, that's really that's my average. I can tell them the low offer, which we
Yeah.
have low offers, and then we can tell them where it landed. And sometimes we come back with no offer and we just tell them like, here's the good news. No one thinks you're going to die anytime soon, period. Or your premiums are too expensive. You're going to live at least 10, 15 years, but your premiums, you're going to spend that in premiums in 10 years. So the policy's upside down if you don't pass away. And then that's too risky for the investor.
What would be a circumstance like that where you've got a premium that's just too expensive? Is that just somebody that got their life insurance super late in life, or
Yeah.
um, in
Yeah.
most cases? Yeah.
It's just there are cases that if you read any of the financial papers, which I try not to do too often because they're depressing, you'll see COI increases, cost of insurance increases, just
Yeah.
randomly selected among a certain class inside of insurance carrier, which again I think is illegal, and they get sued and they lose all the time, and they class action fashion, and they send out money to everybody because they go overpaid their premiums. So you're allowed to do certain things, but you need to go through the state and say, okay, I'm going to raise my insurance premiums because I just made up a reason in my head that I'm going to do it, and they
Yeah.
do it, and they usually get approved. But then some people just take a shortcut, just do it anyway. They just do it and they don't care. I mean, life
Yeah.
insurance companies are God bless them. I love them because without them, I wouldn't be in business. But at the same time, they don't care much about guardrails. I kind of take them down. They just go at it as if they want. They create products. I mean, there's a case, Leslie Stahl did an 60 Minutes interview with a company, I guess it was based out of Alabama. The client had owned an annuity and a life insurance policy at the same time, and they died. The day he died, they immediately cut off the annuity payments by searching the Social Security Death Master file. But they let the trust continue to make premium payments on the insurance company for 20 years.
Oh my gosh.
Yeah.
Wow.
Why
Yeah.
tell them? Here comes the money. So all they had to do was when they figured it out, the trust, they just call the insurance company. The insurance company absolutely paying the death benefit, but not the interest. that they made
Yeah.
on trading for 20 years. So that's the difference. They're clued into things they want to be clued into. Now, there are great insurance companies, and most of them are, but there are some that I think are less than stellar. And there are people in our business that won't buy certain life insurance policies. And that's like at the flavor of the month in an ice cream store. We don't want to buy this company this month. We want to buy that company this month, whatever it is. And it's because of actions like that.
Yeah, makes sense. Well, this has been super interesting, Rob. How can the audience find out more about you, about your company, if they considered, if they want to consider to potentially sell a policy or just have you maybe take a look at what they've got?
Well, I can be reached at rob at lisettlements.com. That's Larry Igloo settlements.com. And my phone number, sell is best, 954-599-4433. Those are two ways to get a hold of me. And if I can't help you in my office, I will make sure that I have somebody that does it. Again, we got a pretty seasoned staff here, and we'll be more than happy to answer any questions you may have as well.
Perfect. No, I really appreciate it. This has been super interesting, and just you've really helped myself, and I'm sure the audience understand a lot more about, what this industry is and the potential benefit. So thank you so much.
My pleasure.
I've got two more questions for you. One would just be any advice you would give somebody who's maybe just starting out in their investment journey. I know we didn't talk too much about investment, but life insurance turns out potentially an investment.
Well, that's a good question. So I was taught very early on to seek counsel from multiple sources. Don't just go to one, and feel who you feel you're most comfortable with, and then to always diversify. Don't just pick one thing. So when I talked about a little bit of life settlement investing in our business, I don't know anybody that buys one policy. They got to buy many because they understand that it's not a perfect world and you're going to make mistakes, but you're also going to make mistakes that benefit you. So thereby you should buy more than a lot. So I invest in all kinds of different areas. And then the other thing I don't do is I don't read anything. So if something comes in the mail that shows me how much money I have, I throw it right in the trash. I don't want to look at it. I don't want to touch it. I just keep going. Obviously, I want to be alerted if it's bad and I didn't read it. But at the same time, so far that hasn't happened. Knock on wood.
Yeah, no, fantastic. I think that's great advice. How about a book recommendation? Doesn't have to be insurance or investing related, just something you read that's been impactful.
Well, it's funny you said that because I was just talking about a friend about a book. So the two books that I got a book from the guy that started me in this business and my best friend in this business, and both decided to get me leather-bound copies of The Art of War, and both signed inside the books very deep and meaningful things to me. So I count that book as one of my things that I recommend to people. And there's another book that's called The Confidence Game, which I read about. I won't tell you why I read it. But it's a book that kind of looks into con men, if you will, and people and not necessarily con men in the sense of I'm conning you to take your money, but conning you into believing something you may or may not believe in. And this young lady wrote the book. I saw it on Morning Joe, and I said, I got to get a copy of that. I read it 3 times, and each time I read it, I feel like I'm reading a different book because life goes on and passes by. So I'm trying to read it every couple of years. It's a very easy book to read, but you get a lot out of it. You get to see some signs that you didn't notice there were signs at the time. So I recommend that one. I can't remember. And what's funny is you tell me as I'm saying this, I don't even remember who wrote the book, but I'm going to tell you in a second. Maria Konnikova.
Okay.
Confidence Game. It's really kind of like people like to watch mystery shows and whatnot. It's kind of like that, but at the same time, she's giving you clear indications. And if you understand the reason why she wrote the book, it'll become a lot more clear as to why she wrote it.
No, perfect. 2 great recommendations there. So, Rob, this has been great. Thank you so much, and I think we'll call it a show.
Well, thank you, Keith, for the time. I really appreciate it.
Yeah, appreciate you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.